All right, and with that, let me bring on board Richard Yetsenga, who's economist at ANZ Group, joining us this morning. Richard, great having you. Let me first start off by understanding from you the impact of this, right? What we're seeing is that the US 10-year bond yield is now again at 4.6%, and we've seen this bit of fluctuation. Uh, Earlier, the ceiling was 4.4, inched up towards 4.5. Now the ceiling seems to be 4.6. Markets seem to be testing the fact that you could see oil prices higher for longer and therefore rates may have to go up.
It's not just oil prices. I think you're right to call attention to what the bond market is doing. But even over that, if you like, MOU period in May and June, when we saw a bit of maybe a hope that the conflict had passed its worst and would reach some sort of more sustainable resolution, the front end of bond markets never really retraced all that much. They still price this kind of risk of either flat rates at best or tightening in many, many places. And I think all that's happened now is with oil up, look, about 30% from the lows, 70 to 90, it's just rekindled that kind of inflationary concern, that higher for longer concern, and the risk that the Fed, at some point the Fed just says, look, inflation's been above target for 5 years. Do we just have to step into the market and snug rates up a bit so we get more confident that we're actually going to come back to 2% over time?
Hi, morning. In that backdrop, how do you look at some of the commodities in that sense? The way crude is shaping up, is going back to $90. Do you see inflation risk again coming back for many of the economies?
Look, I do. I think the way markets are responding is broadly appropriate. And let's not forget, we've got this added complication. We've got oil up and the AI trade down. So at the moment anyway, so there's a few cross currents going on. And the fact that we've been in the middle of, the largest supply shock to the energy market in history, and the global economy has managed that in pretty reasonable shape, does suggest that markets are right to view this as an inflation problem rather than a growth problem.
And Richard, in the interim, till the world finds its order around West Asia, do you sense there could be a shift to flows getting back to emerging markets like India?
Look, I hope so. I think, again, there have been a few countries that are taken as kind of epicenter of problems, if you like. But in fact, I think India has performed relatively well when you think of the scale of the challenge. In fact, compare the performance of India this year to 2013 during the taper tantrum, and it's really chalk and cheese. This year has been a bit of a setback for the currency and for markets, if you like, but the Indian economy has continued to do very well. In fact, growing at, look, let's round it up and say more than 6% comfortably. That puts India at kind of double the G20 average, or more than double the G20 average, and China now growing in the low fours. It really makes India stand out. And I think if we can just get, it doesn't have to be complete calm in West Asia, in the Middle East, but if we can just get at least an idea about where the parameters here and where the edges of the conflict might be, I think markets can get comfortable with that and perhaps again move forward.
Okay. And Richard, wonder how you're looking at the entire precious metals pack at a time like this. Gold, silver, we've seen a sharp pullback in prices over there. Maybe a good time to kind of reallocate towards precious metals, just given the environment that we're in?
Look, I think the answer to that depends on your time horizon and your risk appetite. I don't think we're going back into the sort of gold price action we saw between 2022 and 2024-25, where it seems that almost whatever happened, gold roughly went up every week, every month, and by substantial amounts. I think gold, the fact it's increased so much the last few years means there has been a substantial shift in the balance of supply and demand. The jewellery market is much softer. You've got more investor demand. And in any market where you have more investor demand, that market must also be more sensitive to other things that are going on. And I think at the moment, those other things are going to keep investors away from gold. There's still a long-term structural story there, I think, but not on a tactical time horizon.
And last off, Richard, I wonder how you're looking at this entire capex cycle in AI, right? The economics of it. How much of that is really impacting growth? If that were to come off, what's the likely risk to US as well as global growth? Because that seems to be the real driver at this point.
Look, this AI story is the single biggest driver of the global economy. There's obviously a huge wealth effect through markets, and it's not just the US market, obviously, but North Asia and other markets have increased dramatically over the past couple of years. But also, it's an activity story. A third of a point on US GDP last year, maybe half a point in the first quarter. It's more than a quarter of non-mining business investment in Australia, 3/4 of Asian export growth the last 2 years has been electronic related. So clearly, if this goes through a substantial period of reassessment, that's going to have a big impact on the global economy. I mean, I don't think it's a recession impact, but certainly it would be a downside growth surprise, which would be materially noticeable, and I think would take the tightening risk out of markets for some time.
Richard, thank you very much for joining us today and giving us that perspective. That was Richard